Understanding the debt-to-GDP ratio is essential for grasping a nation's economic well-being. It represents the size of a country's debt in relation to its economic output, measured by its gross domestic product or GDP. A high debt-to-GDP ratio suggests a country may be using a significant portion of its income to service its debt, limiting its ability to invest in crucial areas like infrastructure, education, and healthcare. A high debt-to-GDP ratio can raise concerns about long-term fiscal sustainability. Managing debt is crucial for economic stability and growth. When debt levels are manageable, governments can respond to economic shocks and invest in essential services. High debt-to-GDP ratios can lead to slower growth and potential debt crises. Understanding the debt-to-GDP ratio is essential for policymakers, investors, and citizens. Malaysia, a vibrant Southeast Asian economy, has seen a steady rise in its debt-to-GDP ratio over the past decade. As of 2023, it stands at 65%, exceeding the government's ceiling of 60%. This rise has sparked concerns about long-term fiscal sustainability and economic growth. The government's commitment to fiscal consolidation and structural reforms is crucial. Increased spending on infrastructure, social welfare, and COVID-19 measures have contributed to rising debt. Declining revenue, partly due to fluctuating oil prices, has also played a role. Fiscal consolidation measures have been implemented, but balancing fiscal discipline and growth remains delicate. The COVID-19 pandemic delivered an unprecedented shock to the global economy, and Malaysia was not spared. The pandemic's impact on Malaysia's economy, coupled with necessary but costly stimulus measures, has significantly contributed to the country's recent debt surge. To mitigate the economic fallout from the pandemic, the Malaysian government implemented various fiscal stimulus packages. These packages aim to support businesses, preserve jobs, and provide financial assistance to vulnerable households. While these measures were essential in cushioning the economic blow, they also led to a substantial increase in government spending and consequently higher debt levels. The pandemic also disrupted global supply chains and dampened demand, impacting Malaysia's export-oriented economy. This decline in economic activity further strained government revenues, making it more challenging to manage the debt burden. The Malaysian government has taken steps to address the pandemic's economic consequences, but the road to recovery and fiscal consolidation remains long and challenging. As Malaysia emerges from the pandemic's shadow, addressing the pandemic-induced debt surge will be a priority. A multi-pronged approach involving fiscal discipline, structural reforms, and fostering sustainable economic growth will be essential to navigate this challenge effectively. Section 4. Decomposing the debt, foreign versus domestic, a balancing act. Understanding a country's debt composition is crucial for assessing economic vulnerability. Malaysia's debt includes foreign currency and domestic debt. Foreign currency debt is denominated in a currency other than the borrower's domestic currency. It exposes the country to exchange rate risks. Domestic debt is issued and held within the country. Managing the balance between foreign and domestic debt is crucial. Prudent strategies and policies can help mitigate these risks. Section 5. The oil dependency dilemma, navigating the volatility of fossil fuels. Malaysia's economy has long relied heavily on its oil and gas sector. While this reliance has brought economic benefits, it also exposes the country to the volatility of global commodity prices. This dependence on oil and gas revenue presents both opportunities and challenges for Malaysia's long-term economic resilience. Fluctuations in global oil and gas prices can significantly impact Malaysia's government revenue and export earnings. When prices are high, the oil and gas sector provides a significant boost to the economy. However, when prices decline, as they have in recent years, it can create budgetary pressures and impact economic growth. Recognizing the need to reduce its reliance on oil and gas, the Malaysian government has embarked on a path of economic diversification. This involves promoting other sectors, such as manufacturing, technology, and tourism. However, diversifying an economy takes time and sustained effort. Investing in education, research and development, and fostering a business-friendly environment are essential to attracting investment and promoting growth in new and innovative sectors. Section 6. Charting a sustainable path, fiscal prudence and economic transformation. Addressing Malaysia's debt dilemma and ensuring long-term fiscal sustainability requires a multifaceted approach. This involves a combination of fiscal discipline, structural reforms, and a commitment to economic diversification. By implementing a comprehensive strategy, Malaysia can navigate its debt challenges and pave the way for sustainable and inclusive growth. Fiscal discipline is paramount in managing debt levels. This entails rationalizing government spending, increasing revenue collection through measures like tax reforms, and improving the efficiency of public service delivery. Beyond fiscal discipline, structural reforms are crucial to enhance the economy's competitiveness and attract investments. This includes improving infrastructure, fostering a conducive business environment, and investing in education and skills development to create a highly skilled workforce. Economic diversification is essential to reduce reliance on volatile sectors like oil and gas. This involves promoting growth in sectors such as manufacturing, technology, tourism, and renewable energy. By diversifying its economic base, Malaysia can mitigate risks associated with commodity price fluctuations and create a more resilient economy. Section 7. Securing Malaysia's future, a call for proactive governance. Malaysia's debt dilemma, while a cause for concern, should not be a cause for despair. With proactive governance, sound economic management, and a commitment to sustainable practices, Malaysia can navigate these challenges and secure a prosperous future. The challenges facing Malaysia are not unique. Many countries grapple with managing debt levels and ensuring fiscal sustainability. However, Malaysia's track record of economic growth and its commitment to reform provide a solid foundation for addressing these issues effectively. Transparency, accountability, and good governance are crucial to maintain investor confidence and ensure the effective implementation of economic policies. By fostering a transparent and predictable policy environment, Malaysia can attract foreign investment and promote sustainable economic growth. Malaysia's economic future hinges on its ability to adapt, innovate, and embrace sustainable practices. By addressing its debt challenges head-on and implementing a comprehensive strategy for fiscal consolidation, structural reforms, and economic diversification, Malaysia can chart a course toward a more resilient and prosperous future.